subjects that affects all of us. Things like the real estate market, where it's going over the next year or so, AI, EVs, even things like fraud investigations. But we're going to put a different spin on it today. We're going to talk about what are the hidden risks that are going to be obstacles for your success in 2024. And you might think, well, that's a long time from now. We're into September. It's only a few months and we'll be in 2024. Everybody wants to be better, at least not be worse in 2024. Many of us will make New Year's resolutions or, have hopes and dreams for the next year, but there are hidden forces behind the scenes that are working against you to have those results. Now, you don't want to give up on them. You don't want to just surrender to the fact that these forces exist. If you know about them, many times you can avoid them. You can fight back against them. You can plan for those being in existence. For example, if you're driving down the street and Google Maps tells you that there's an accident ahead, that's an obstacle. You're going to go around it. Same thing with these risks. If you know about them, you can go around them. So again, we'll talk about real estate, EVs. We'll also talk about a risk that not a lot of people think about, and that is the cultural risk, what's happening with society and how that may affect things like your job or your income or even where you live. So first, let's talk about our old favorite, which is real estate. And interest rates and housing availability are the two hot buttons for people. And here's where we're at right now. We're in a place where the housing market is basically stuck. It's kind of in a place that it's trapped. You can't buy a house. You can't sell a house. If you're a home owner and you want to sell your house, it's very difficult because the buyer is going to have to pay a higher interest rate. What does that look like? Well, according to financial publications, housing market is exactly what we said. It's stuck. Americans can't afford to buy a house. Investors are not buying homes. And you might think that's a good thing because investors were thrown off the inventory, and they kind of were. But when they're not buying houses, that means if you're a seller, put you in a bad spot too, because there's nobody that can buy your house if you want to move somewhere else. Little relief ahead. This is September 2nd, a few days ago. Low inventory, high mortgage rates, high prices create a difficult housing market. So the question is, are any of these going to change anytime soon? Low inventory? Where does inventory come from? Inventory comes from either people who have a house now that sell it or building a new one. Is either one of those going to change? We'll talk about builders here in a second. Existing homeowners aren't going to sell because if they sell to buy a new house, they have to pay a higher interest rate on their new mortgage. Builders are maybe stepping in. Housing market is so scarce that builders will be in the driver's seat for years to come. And that's true, but there's still not enough building inventory to catch up. There may be 5 million houses short from what's needed to fulfill the current demand and backfill the backlog. Builders can't keep up with that. What about interest rates? When will interest rates finally come down? That's the big question, because interest rates being high is affecting the market of homes available, but it's also affecting the purchasing power of a home buyer. Interest rates are originated by the Federal Reserve. The Fed has two objectives. One objective is to keep inflation low. The other is to keep unemployment low. Right now, unemployment's not a big deal. But to keep inflation low, they have to jack up interest rates because that slows down the economy. But when you jack up interest rates, it's harder for people to buy a house. When will we finally see interest rates fall? 3 experts say, I think rates will be cutting in 2024, according to one person. However, That's not what the Federal Reserve Chairman says. Federal Reserve Chairman said a month ago they're going to raise rates. What should you do when interest rates go down? Well, definitely buy a house if you can wait that long. The current average mortgage rate on a 30-year loan is 7.9%, basically 8%. That's with an average credit score, 700 or 719. It may seem like a high rate for first-time buyers, but for people who existed back in the 80s and were looking at real estate then, that's what the rates were back in the 80s. So it's not really that high historically. The question is going to be, where will sellers start to come into the market to sell their homes? It's likely that rates would have to come down to 5% or less for a significant number of existing homeowners to want to sell their house and to get into another mortgage. And you might think, well, don't a lot of homeowners have equity? Yes, a lot of current homeowners have decent equity, and that might be something that offsets what they have to borrow. But most people that buy a new house or another house, a replacement house, they're not going to buy a house of the same price. For example, if you bought a house for $200,000 5 years ago and now it's worth $500,000, you have $300,000 in equity. Great. And if you buy a new house, that $300,000 equity will go towards your purchase of your next home. However, you're probably not going to buy a $500,000 house because that's what you're coming out of. You probably want to buy a $700,000 or $800,000 house to kind of move up, bigger land, nicer area, whatever. But if you buy an $800,000 house, now your mortgage, once you take off that $300,000, is going to be $500,000 instead of $200,000. Well, not only are you going up more than double in the amount you're borrowing, you're also going to go up double in the interest rate. And that's going to be a problem because your mortgage payment on your $200,000 mortgage from when you bought your house was probably $1,200. Your mortgage payment on a $500,000 mortgage at 8% is going to be closer to $4,000, probably $3,600. Just spitballing. You do the math on a calculator. It's going to be 3 times as much. Many people aren't going to want to do that $2,000 a month jump just to go up a little bit in house. So until rates get down into the 5s or below 5, most current homeowners aren't going to really want to be selling their house. The chances of it going down to that level, slim to none. Slim to none, because the Federal Reserve has said they're going to go up even more. Even if they drop a quarter point here and there, it's never going to go back down to 5. Right? The rate drops usually are a quarter point at a time. If you're going to go down to 5, that's 3 percentage points times 4 quarters. You got to drop 12 times. Even if they did one drop per yearly quarter, that's going to take 3 years to get down there. And it probably will never get there. So the interest rate is not going to put people back into the marketplace. Now, what's this thing on the screen you see, Homes Cheap? Well, that's something to take a look at in your spare time. We don't sell houses. We don't make money from selling houses. That's just a website where we collect occasionally examples of homes that are for sale in and around the 200,000 range, 200, 220, 240, just to show that there are houses available. So if you're dying to get into a house to become a homeowner and you can live with something that's less than perfect, there are houses available. Just keep that in mind, right? It may not be your dream house, may not be a luxury house, but at least you can become a homeowner at a relatively low price, ride the wave of price increases if you think that's going to happen, and still be able to get into a home. We always update that pretty regularly. Now, here's the big question. What about AI? What's going on with AI? And how is it affecting jobs? How is it affecting safety? Instead of actual human, you're more likely to have to deal with artificial intelligence on a regular basis. How does that show up? Well, scary news first. Scary news is, according to The Atlantic, robots are already killing people. Well, gee, that sounds ominous. The AI boom underscores a problem that's existed for years. in reality, it's not that robots are coming out and stabbing you, but they're making mistakes and they're creating intrinsic environments where, whether it's on your job, medical field, maybe doing calculations for something, it's creating unsafe working environments or cultural environments. And it's not going away. Companies are spending billions of dollars to develop this. The investments just recently for July of 2023 reached 1.9 billion from 48 funding rounds. Companies are going all in with AI and robotics because they want to save money and they want to have their company be able to do more with less employees. How does that show up for you as an employee? Well, one way it shows up is they're coming for your jobs. How bad is it? Well, some jobs are probably more at risk than others. Here are 10 roles that AI is most likely to replace. It's the ones you probably are going to think about. It's things like copywriting and technical development. Sometimes you're going to have coders, programmers, software developers, data analysts. But a lot of these are the higher paying jobs. And there's a lot of people in this work. It's also going into media, advertising, content creation, journalism. A lot of people are in that field. Legal, paralegal assistants, market research, teachers, finance jobs. If you take all these jobs together and you see, well, how many people are in these businesses, you're talking lots and lots of jobs that are at risk. How does that affect you, even if you're not in one of these jobs? Well, here's how it affects you. Whatever job you're in, at some level, has customers that are in one of these jobs or in one of these industries. And if your company has less income, less revenue, because your customers or your customers' customers are being affected by AI, guess what? That's going to affect you. And that's going to be something that at some point has a ripple effect, a domino effect that either keeps you from getting a promotion, maybe it keeps you from getting a raise, or even takes your job. How big of a problem is it? Well, there's different opinions, but the scariest part of it is that even experts don't know how bad it really is. How worried should we be about AI's threat? Even tech leaders can't agree, right? Is it an AI apocalypse or just bias like in disinformation? Artificial intelligence pioneers are fighting over which is scary. So when the experts can't even agree, what does that tell you? It means that there could be a risk that we don't know about. Even if you do have a job, it may turn out that your boss is a robot. Remember Robert Reich? He was a member of the Bill Clinton cabinet, very high level role of the Labor Department. He's saying that artificial intelligence might become your employer. It may end labor unions and become your new employer. Middle-class workers may bid for jobs as a result of artificial intelligence. The rise in productivity and loss of jobs may require a universal basic income. What they're saying is there's not going to be enough income to go around from these companies, so the government might have to step in and pay people because the robots are doing all the jobs. I know you have an opinion about that. Let us know in the comments. And obviously, one of the first areas that is being affected, like we talked about, are things that are more virtual. For example, if you like the idea of your company letting you work from home, be careful with that. Work from home guru says that AI is already coming from fully remote jobs like call centers, And this is a real risk. So the easier and cushier you make your job, the more at risk you might be for artificial intelligence or AI taking over your jobs. Now it's a catch-22. You don't want to, kill yourself and overstress yourself and affect your mental health. But if you make it too easy, your job might say, well, gee, if it's that easy, we can get a robot to do it. What are your thoughts about that? It's a big deal, wouldn't you say? What other area of future development could affect you in 2024? Well, as you know, we always like to talk about electric vehicles. Why? Well, mostly because they're coming, and mostly because most people aren't prepared for it. You may not have an electric vehicle now, not want an electric vehicle, but it's something that you might have to face having in the coming years. Maybe not next year, but in the next 3 or 4 years. How bad of a problem is it? Well, let's look at 5 very, very serious risks from having an electric vehicle. First of all, catch on fire. Electric cars soaked by salt water from hurricane go up in flames. Here's the picture. Where's the picture? Well, it was in here. Must have changed it. Maybe it's here. Nope. Bottom line is that these cars are catching on fire and they're burning up, right? So, and that's not from a crash. It's not from catching on fire. It's being immersed in salt water. Is that a risk you want to know about? Probably is. What are the other risks? What about financial risks? For the last 50 years, 60 years, auto repair has become an industry that people can count on. Your car breaks and there's mechanics. They've been trained. They created businesses, but electric vehicles don't have the same number of experienced mechanics. If your EV breaks down, you might not be able to find a mechanic to fix it. Or you might find one, but they might say, come back in a month for a basic repair, because these vehicles are different types of repairs. Underneath the vehicle is this sealed tray with the battery. And look at this guy. He's wearing eye protection, goggles. They're very, very hard to repair. And the parts are hard to repair, to get, and the repairs are hard to get done. So be aware that that might be a risk. What about insurance on these cars? Are they more expensive to insure? Well, right now, they actually are. Why is that? Well, because the loss rates are a lot higher. These cars are more expensive to fix. We just saw that in the repair. And minor impacts can create serious cost, expensive claims. Because if you get a minor fender bender on this car, it could jostle or vibrate that battery, and the battery costs $10,000, $15,000. Right? Electric cars, insurance costs, hint, they're higher. They tend to have newer and more updated technology, which is more costly to repair. Vehicles are still more expensive than the average vehicle. If your EV is involved in an accident, the high voltage battery could be damaged and needs replacing. That could cost tens of thousands of dollars. Parts are hard to get because of these are not major big factories building lots and lots of parts. Right now, it's still kind of a boutique industry. So that's going to put your insurance higher. Did you take that into account when you're thinking about it? Even renting them is indicating that people aren't ready for this. How so? Well, a lot of the rent-a-car companies, Hertz, Enterprise, Avis, they're putting more electric vehicles in inventory, but nobody wants them. The electric vehicle revolution is coming, ready or not. Plenty of travelers fall into the or not category. Mostly because the EVs aren't charged, they lack accessories, or people are worried about where they're going to recharge it. Can't just pop into a gas station. This person reserved an intermediate car from Washington, D.C. The rental agency didn't have her car, but they got an EV. which no one at the counter mentioned. Despite getting charged overnight, the battery drained quickly. With 70 miles to go, the range flashed 30. She had to hunt for a charging station. So this created the inconvenience. Last thing you want on your vacation is an inconvenience. What are your thoughts on that? How does that affect your plans for getting an EV, wanting an EV? Let's take a look at building industry. Why? When it comes to employment and economy, construction and contracting is one of the biggest employers, and it's one of the biggest factors in the real estate market. What's happening with the building industry? Well, what you're finding is the housing market could cool, but builder stocks could rise. Here's why. Builders are in a unique position where they can pick and choose what work they want to do. When the housing market falls, they can pick more profitable projects. Rather than volume, they're going to do profit. More profit on each one versus less profit on a larger number of homes. Actually, the amount of oversight and management and attention it takes to build a small house is about the same as to build a big house. Yeah, there's more work involved, but it's something that doesn't scale linearly, apples to apples. Do you think that all of these factors scheming together are going to affect your future in 2024? EVs, AI, housing market, and if so, how is it going to affect you? Let us know in the comments below. We want to hear what your opinion is. Come back a little later today. We're going to talk with some facts about what might be going on with the fire that was in Maui and Lahaina and how that might relate to developments in your area and might be a risk to you in the